Hi folks, welcome to the latest in the series of Meet the Manager videos that we're running here. Today I'm pleased to say that I've got Scott Wolle, who is the Chief Investment Officer of the Global Asset Allocation team at Invesco. He's based in Atlanta, he's over in London at the moment. I'm pleased to have him with us. Scott's team runs a number of funds that are available to UK-based investors, and we're going to touch on those today. Scott, thanks very much for joining us.
My pleasure. Thanks for having me.
Maybe if I could just kick off by asking you about the balanced risk strategies that you run through these funds that are available to UK investors, and maybe just give us an idea in simple terms of how exactly they work.
Sure. Well, the underlying concept is that asset classes respond in very predictable ways to different parts of the economic environment. So, for example, equities do quite well when GDP growth is good and inflation is under control, but tend to do poorly during recessions or periods of sharply rising inflation. So the risk that we're trying to balance is the risk of those different economic outcomes. Accordingly, we have exposure to stocks, government bonds, and commodities to give us an opportunity to really provide some insurance and a smoother ride around the economic cycle.
Fine, okay, thank you. So of those three asset classes that you invest in, equities, commodities, and bonds, the one that I think some people might have some concerns about would be bonds. Sure. Just given that the yields do seem to be artificially low right now. How are you dealing with that in the portfolios that you've structured?
Sure. So there are probably three main ways that we can talk about for bonds. The first is how we think about the risk of bonds. The second is the level of yields right now relative to what we think fair value is. And then lastly, our tactical view on bonds. So when it comes to risk for bonds, the way we think about risk is related to duration. Now, without getting into some of the technical details of that, effectively what happens in the portfolio is as yields fall, the duration rises, so we think that bonds are riskier at low levels of yields, a very natural way to think about bonds. So we actually had some of our lowest strategic bond allocations in the life of the strategy over the course of the last couple of quarters. Now, however, with yields having risen by about 100 basis points in most developed markets, we actually think that bond yields are a little bit higher than fair value. And so when we're asked about do we think it's likely that bond yields will continue their a very steep climb from here, we think the answer is probably no. We think probably the right level of yields in the US is about 2.5 or 2.75%, and we're just a bit above that right now.
Okay.
Now that does lead into our tactical view on bonds overall, which is right now we're fairly neutral. We've gone from slightly underweight to neutral over the past few months, and as yields continue to rise, we'll have a bias to add bonds to the portfolio overall.
Okay, fine. So just to recap, so essentially you're weighting commodities, equities, and bonds in terms of their risk rather than in terms of the actual percentage allocation in the portfolio. But then you have this tactical overlay where you adjust them. Could you maybe just talk a little bit more about that tactical overlay in terms of what would drive you to have a little bit more in equities than the neutral risk position?
Sure. Well, we think about three main categories of factors. The first is valuation, the second is the prevailing economic environment, and then the last is investor positioning. So for valuation, we're looking at very classical notions of valuation, a dividend discount model for equities, what's called the Fisher hypothesis for bonds, and supply and demand balance for commodities. The economic environment, we'll really think about that a bit differently for each of the different asset classes. And for equities, there are really two main considerations. First is what is the risk of recession? And then secondly, what's the overall financial conditions in particular markets? Right now, we see valuation as generally supportive for most of the markets we invest in, and the risk of recession as being fairly low and financial conditions being good. When we add in investor positioning, which really relates primarily to price trends, that's also supportive for equities. So really, no matter what angle we look at with equities, we see them as being fairly attractive. What's unusual about the way that we think about tactical allocation relative to many other managers is that we don't have to make a choice of either stocks or bonds. Because we're using derivatives to implement the strategy, we actually could be overweight every asset class at any particular point in time or underweight. Right now, however, we do have the strong preference for equities and are more or less neutral for both bonds and commodities.
Fine, okay. Now, one subject that is close to my heart is the extent to which managers eat their own cooking, if you like, are personally invested in their own funds. Is that something you're able to talk about in relation to the funds that you and your team run?
Absolutely. One of the advantages of the way that Invesco is structured is that we have funds available not just to UK investors, but also to continental European and US investors. And as a result, all the senior members of the team have a very substantial portion of their net worths invested in the strategy.
I understand some of this is public knowledge in the US, so there is actually a number which is out there. Would you care to share that with
So the
viewers?
way in the US we have to release statistics around that, and there are different categories, and so for the senior members of the team, we each have over $1 million invested in the funds.
Okay, thank you. And just one maybe question to finish on. So in terms of getting exposure to these different asset classes, there will be underlying markets that you will get exposed to. Are there any in particular at the moment that your tactical overlay is showing as particularly attractive? Any particular underlying equity markets or commodities?
Yeah, well, really, as I said before, equity markets generally look very attractive to us still, and they have for the last 18 months. Within equity markets, Hong Kong is not quite as attractive as some of the other markets, simply for it's not been quite as well behaved from a technical perspective, and valuations, while a lot better than they have been, are still a little bit higher than we'd like to see them. But really, the rest of the developed world is really fairly attractive.
Okay, great, Scott. Thank you very much for your time.
My pleasure.
Hopefully that's been of interest. If anybody would like further information on the funds run by Scott and his team, please contact your broker. Thank you.